Welcome back to Markets Without Spin. I'm Franz Amundsen. In the last episode, we pulled back the curtain on how modern executive compensation actually works and why it has drifted so far away from true ownership. We talked about how earnings per share targets drive decision-making more than strategy, how stock options, performance grants, and restricted shares quietly dilute shareholders year after year, and how the dilution to buyback to redilution cycle allows executives to unload shares into liquidity windows they helped create. We walked through the reality of 10b5-1 plans and how they are often timed to coincide with buybacks, and how total shareholder return windows encouraging managing the stock price instead of managing the business. And we ended with this. The modern incentive system creates short-term executives, not long-term owners. Everything about today's compensation machine pushes management towards monetizing stock or the stock price and not building companies. Which brings me to the perfect contrast, the Warren Buffett contrast. Before we get into today's topic, I want to start with one clear example of what true alignment actually means and what it looks like. And it's the opposite of everything we've talked about so far. Look at Warren Buffett. I just got his latest annual report yesterday, and I read the letter to stockholders. And I think this is the first one which was not written by Warren Buffett himself, but the new manager. But look how Warren Buffett ran the company until his retirement. Berkshire Hathaway does not issue stock options. That's Warren Buffett's company, Berkshire Hathaway. He does not hand out restricted shares. He does not dilute shareholders to motivate executives. And he has never sold a single share of Berkshire in his entire life, personally. Instead of loading management with stock packages, he pays his people extremely well, in cash, and then expects them to behave like rational stewards, not short-term monetizers. It's simple, it's transparent, and over 6 decades, it has created one of the greatest compounding machines in financial history. Buffett doesn't rely on loopholes, prearranged selling plans, or buyback-driven liquidity windows. His incentives match every other long-term shareholder because he is one. He wins when they win. He loses when they lose. That's alignment. And the fact that a model like this exists and works shows just how far today's corporate incentives have drifted from true ownership. And now that brings us to today's episode. Because if you want to understand modern markets, the rallies, the cracks, the volatility spikes, you have to understand something even bigger than incentives. You have to understand flows. This episode is titled Flows, Machinery, and the Passive Bid, How the System Actually Moves Markets. Let's get into it. For most of my career, markets were driven by people thinking, analysts covering industries, portfolio managers making decisions based on valuation, buy-side desk taking positions after real research, people looking at balance sheets, talking to management, doing actual work. If a stock moved 2 or 3% a day, you could usually trace it back to somebody making a decision. But over the last 15 to 20 years, that's changed dramatically. Today's markets are driven far less by valuation and far more by rules, schedules, and mechanical flows. ETF inflows, index rebalancing, target date fund allocations, risk parity trades, volatility targeting models, systematic option strategies. These flows don't think. They don't ask whether a stock is cheap or expensive. They just buy when the model says buy, sell when it says sell, and rebalance when the calendar says it's time. If episode 3 was about incentives distorting corporate buyback behavior, episode 4 is about the plumbing distorting the market behavior. And once you understand these flows, a lot of the last decade's price action suddenly makes sense. The passive bid, The most powerful force in modern markets is something most investors never consider: the passive bid. Every 2 weeks, millions of Americans get paid. A slice of that paycheck is automatically deposited into a 401k plan for most of these individuals. That 401k plan automatically buys a target date fund or an index of some sort. And that fund or index automatically buys the same stock in the same weights every single time. There's no debate about valuation, no concern about the economy, no, is this a good time to buy? Just money to target date fund or index fund to market. That's an assembly line of buying pressure. And it happens in every market environment, up, down, sideways, year after year, decade after decade. The passive bid has been the single biggest tailwind for U.S. equities since the early 2000s. It dampens volatility, lifts valuations, reduces downside follow-through, and creates the illusion of stability. But that stability only exists because the money keeps flowing in. And that's beginning to change. This is the demographic shift almost no one talks about. For 20 years, baby boomers powered the passive bid. Their contributions were heavy, automatic, and predictable. But now, they're retiring, they're beginning their required minimum distributions, they're shifting from equities to bonds as target date funds age. They're drawing from portfolios instead of adding to them. All of this systemic selling, not emotional, not panic-driven, but scheduled and unavoidable. The constant automatic buyer becomes a constant automatic seller. And markets that have been priced for nonstop inflows behave very differently when the flows slow, flatten, or reverse. This shift will define the next decade. Now we move on to buybacks, which we talked about, and this is the second passive bid. Now this is tied back to episode 3. Corporate buybacks have become the second major price-insensitive buyer in U.S. equities. In many years, corporations themselves have been the largest buyer of stock, bigger than households, pensions, or institutions. They buy mechanically, they buy on schedules, they buy without regard to valuation, and they buy heavily when executives are selling. Buybacks soak up supply, create liquidity, and push earnings per share higher even when the business isn't growing. But here's the issue. When the markets turn, when credit tightens, when uncertainty rises, buybacks disappear. Boards suspend them, banks pause them, companies conserve cash. And without that second passive bidder, the market loses a major stabilizing force exactly when it's needed most. That's why declines sometimes feel like air pockets, because structurally that's exactly what they are. Now let's look at the plumbing of the market. The part of the market most investors never see. When a stock is added to a major index, something very predictable happens. Every index must buy it, every ETF must buy it, every benchmark-hugging mutual fund must buy it, all at once. It has nothing to do with the business. It has nothing to do with value, nothing to do with prospects. It's just plumbing. Stock enters the index, funds must buy. And when a stock leaves an index, the reverse happens. Every fund must sell. The same mechanical behavior repeats during monthly and quarterly rebalances, sector rotations, volatility targeting readjustments, equal weight versus cap-weighted shifts, option-driven hedging, systematic trend models. This is why the market often moves on days when nothing happens. Something did happen. It just happened in the pipes. Now let's talk about liquidity, or the illusion of liquidity. We live in a world where ETFs, options, and futures trade constantly. Everything appears liquid. but most of that is secondary market liquidity. Investors trading with one another, not true liquidity in the underlying asset. Index funds and ETFs are liquidity takers, not liquidity makers. They depend on the market makers and arbitrage desks to provide liquidity at rebalancing points. But when the market moves quickly, those liquidity providers step back, spreads widen, depth vanishes, prices gap, and the liquid ETF suddenly behaves like an illiquid small cap stock. You've seen this in flash crashes, volatility spikes, and bond ETFs disconnecting from net asset value. It's not a glitch, it's how the modern system works. Liquidity is abundant until the moment it isn't. And here's the problem nobody wants to talk about. Here's the uncomfortable truth. For the last decade, the U.S. stock market has been supported by two massive price-insensitive buyers, the passive bid and corporate buybacks. Both are now vulnerable. The passive bid is flattening as retirees outnumber contributors. The passive ask, withdrawals, is accelerating. Buybacks are slowing as debt becomes more expensive. Liquidity is thinning, especially outside the mega caps. Index concentration is increasing and amplifying moves. Systematic strategies magnify volatility the moment flows turn. And there's another layer investors often miss. For 15 to 20 years, corporations enjoyed extraordinarily high profit margins, helped by low inflation, stable costs, cheap capital, and steady demand. That era is shifting. Inflation, even moderate inflation, pressures margins. When companies can't raise prices freely, when consumers push back, when costs outrun revenues, margins compress, and margin compression hits earnings faster than almost anything else. Now add a softening labor market. Even a small rise in unemployment means fewer 401k contributions, fewer target date flows, fewer passive bids. And now you have fewer contributions, fewer passive inflows, weaker earnings, reduced buyback capacity all at once. At some point, gradually or suddenly, the rate of money leaving the market will exceed the rate entering it. And when that happens, the big question becomes, who replaces the passive bid? Who absorbs the selling? It won't be the retirees, they're the sellers. It won't be the corporations, buybacks disappear when earnings fall. And it won't be target date funds, they shift towards bonds as their investors age. You don't need a crisis for this to matter. You just need a steady imbalance, fewer automatic buyers, slightly more automatic sellers. Markets don't need a bear story, they just need a flow shift. And that is happening quietly, mechanically, relentlessly. Let me leave you with this. Investors are trained to analyze stories, earnings, headlines, and forecasts. And those matter eventually. But in the short term and medium term, markets move on something more basic. Cash flow, mechanical flow, scheduled flow, systematic flow. Understand the flows and you understand the market. Ignore the flows and the market will constantly surprise you. The steady, predictable, passive-driven support is beginning to shift. The next decade will not look like the last. And in many ways, we are returning to a market where actual stock picking, valuation discipline, and fundamental research matter again. That's where we're heading next. If you found this episode helpful, share it with someone who cares about markets without the noise. And if you're enjoying the series, remember to follow the show so you don't miss episode 5. Thanks for listening. I'll see you in the next one.